A very good afternoon to all friends. I'm Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board on behalf of the AASB, on behalf of my Vice Chairman Vishal Bhai Doshi ji and Gyan Mishra ji, who's the keynote speaker. I welcome you all to this 102nd program of AASB for this council year. Today's topic is key consideration in audit of the real estate sector. Friends, we have been organizing programs from time to time to enlighten our members on the key issues in the audit. And we have covered all the auditing standard guidance note, and now we are covering specific topics. So today we are covering the real estate sector. And the endeavor of the Auditing Standard Board is to take the auditing standard related knowledge to the doorstep of every member. That's why we are going topic by topic, sector by sector. And I have the great pleasure in sharing that C. Amit Hundia is our very renowned speaker. He is the guest speaker for the day. And this program is being organized along with the SR branch of the Institute of Chartered Accountant of India. The chairman, CA Paramjit Singh, is with us. It's really a matter of great pleasure and pride that our branches are also undertaking this journey of learning on the auditing standards, because normally, the interest in learning in the auditing standard tend to be lower, and in taxation it is higher. So I would like to compliment the SR branch also for participating in this webinar. Friends, from the ICI side, we have also constituted an expert panel wherein you can ask our panel the audit related queries, and this service is without any charges for the members of the Institute of Chartered Accountant of India. So kindly do avail the same. And may I now request CA Paramjit Singh ji to kindly introduce the guest speaker for the day, CA Amit Hundia ji.
परमजीत जी आप म्यूट पे हैं।
थैंक्स सर। सबसे पहले मैं ऑडिटिंग एंड इंश्योरेंस स्टैंडर्ड बोर्ड को थैंक्स देना चाहता हूं कि उन्होंने सारे ब्रांच को मौका दिया, और चेयरमैन सर सीए डॉक्टर संजय कुमार सिंगल जी को भी मैं थैंक्स दूंगा, पूरी टीम को, कि उन्होंने सारे ब्रांच को मौका दिया। सीए डॉक्टर संजय कुमार सिंगल जी, चेयरमैन ऑडिट इंश्योरेंस स्टैंडर्ड बोर्ड ऑफ आईसीआई, सीए ज्ञान चंद्रा मिश्रा जी, वाइस चेयरमैन सीपीई ऑफ आईसीआई, एंड सीए विशाल दोशी जी, वाइस चेयरमैन ऑफ ऑडिटिंग इंश्योरेंस स्टैंडर्ड बोर्ड ऑफ आईसीआई, आवर गेस्ट स्पीकर सीए अमित हुंडिया जी। तो सभी का मैं धन्यवाद करता हूं कि उन्होंने आज का जो हमारा वेबिनार है वो है वेबिनार ऑन की कंसिडरेशन इन ऑडिट ऑफ रियल एस्टेट सेक्टर, जो कि आज के टाइम में सबसे बड़ी हमें नीड है कि रियल सेक्टर में सबसे ज्यादा इश्यू हमारे पास आते हैं। तो इसके लिए मैं ऑडिटिंग इंश्योरेंस स्टैंडर्ड बोर्ड को थैंक्स देना चाहता हूं, पूरी टीम को थैंक्स देता हूं कि इन्होंने इस टॉपिक के ऊपर वेबिनार किया। और सबसे पहले मैं बधाई देता हूं कि इन्होंने 100+ वेबिनार जो है हो चुकी हैं, और हमारी 102 ये जो सेकंड वाली जो 100+ वाली जो वेबिनार है, तो पूरी टीम को, चेयरमैन सर को, वाइस चेयरमैन सर को जो मैं बहुत बहुत बधाई देता हूं सर। थैंक्स सर। आज के हमारे जो स्पीकर हैं सी अमित हुंडिया जी, तो उनका थोड़ा सा ब्रीफ मैं आपको बता देता हूं सर। अपार्ट फ्रॉम बीइंग ए चार्टर्ड अकाउंटेंट, ही इज आल्सो ए क्वालिफाइड कंपनी सेक्रेटरी, ए लॉ ग्रेजुएट, ए कॉमर्स ग्रेजुएट एंड दिशा होल्डर। He possesses rich working experience of more than 20 years in the field of insurance advisory service, working in instrument assignment as a technical reviewer of quality review board formed by SEBI, technical reviewer for financial reporting review board formed by ICI. Presently, he is a partner of Singh and Company Chartered Accountant Network, member of More and Global. Previously, he was a partner with Video Harry Bhakti. His industry exposure comparison of NBFC, housing finance, stock broking, real estate and infrastructure, gaming and hospitality, manufacturing and service sector. तो सर के बारे में कहूँगा कि इन्होंने कोई सेक्टर छोड़ा ही नहीं है जिसमें एक्सपीरियंस नहीं है सर का। On sharing of the knowledge front, he has been a speaker as auditing and insurance standard board, WRIC and various forms of ICI. He possesses the international exposure also. He has worked and secondment in the New York and other places of USA. Specialization in the field of company law, IPO, feeling and corporate governance matters and has depth knowledge of the accounting and auditing standard. तो सर आपका बहुत बहुत स्वागत है आज के हमारे वेबिनार में। तो हम रिक्वेस्ट करूंगा सर से कि वो अपना जो है स्टार्ट करें अपना आज का टॉपिक, वेबिनार ऑन की कंसीडरेशन इन ऑडिट ऑफ रियल एस्टेट सेक्टर।
Thank you, Paramji ji. Thank you, Sanjeev ji. Thank you very much for the brief introduction and welcoming me. Thank you to Vishal Bhai Doshi. Thank you to Paramji ji and to the entire committee members of ASB. It's an honor and pleasure for me to speak and to share some of my thoughts or views with the limited experience and knowledge which I have. I hope I'll be able to disseminate some kind of good learnings with all the participants today. So with this, we'll start with today's session. Before we begin with today's session, the today's session deals basically with key considerations in the audit of real estate sector. So we are going to discuss in detail about what is the sector and what are the key matters or key aspects which one has to think of or thought of or to consider while doing the audit of real estate segment. As we all know, real estate segment is one of the key important area. I mean, across the industries in India, and it is being looked upon very diligently. And because of its nature and its structure, I mean, sometimes it appears to be a very complex kind of structure, specifically in large groups where there are different SPVs. So it's one of the critical aspect to have the domain knowledge while doing audit of this particular sector. So we'll touch upon briefly. Brief description about the sector is that, I mean, what do you mean by real estate? So real estate means something which is including land as well as building and rights in relation thereto. And land includes everything above and below the ground. So, I mean, that's a brief description of the real estate. So it means in that sense, real estate sector will include purchase or sale of plots, land, construction or development, etc. Real estate is an imperishable asset, as you all know. I mean, there are many assets which are perishable in nature, but there is something which is imperishable and which is ever increasing in value, specifically in India. In India, it's not having any deterioration in terms of valuation. Real estate in India is one of the most favored destination of FDIs. Key segments of real estate sector. Key segments. So if we see, I mean, broadly, there are three categories. One is residential real estate segment. Second is commercial, and third is hospitality. Main players in real estate market. So some of the key players are landlords or owners, builders, developers or contractors, real estate agents, tenants, and investors. How real estate industry works. So as I had briefly touched upon, I mean, in real estate, normally, if there are large groups, they will have separate SPV. So when I say SPV means a special purpose vehicle, a separate entity for a respective project. So that separate entity can be in the nature of a company, LLP, partnership firm, AOP, etc. So most of the large groups will have separate entity for separate project, whereas their flagship company may have multiple projects, and more specifically in case of listed company. So the probabilities are large to have the appropriation of revenue over a period of time. Otherwise, it creates a huge gap. Funding by parent company, funding through FDI, IPO, lender and PE investors. Development through joint development agreement. So in our coming slides, we will touch upon and we will discuss what do we mean by joint development agreement and what is its relevance. TDR in real estate sector to develop a project. So TDR is a terminology called as transferable development right. So the rights which are being acquired to develop a particular area in addition to the FSI which is available for a particular land bank. SRA model, which is slum rehabilitation model for development. Friends, what are the key factors which are affecting this industry? So if we see the key factors which are going to affect this industry are interest rate. So interest is something which is very important. If interest is on a higher side, it will impact the project costs, the loading of the cost. Even the customers will not be very keen to buy properties by having the home loan. Demographics. So which demography the property is located. Again, that is one of the important factor. Which particular zone. So whether it is in rural areas, city area, tier 1, tier 2, tier 3 city, etc. Demand and supply of property. Location and area of property. So even a particular city or particular tier 1 or tier 2 location. Again, it's located. The property is located at which particular area, whether it is at a prime location or non-prime. So all these things are affecting the valuation and pricing and the demand of that respective real estate project, property pricing, government policies, subsidies, etc. Major regulations which are governing the industry. We know that. In general, we know that there is Companies Act in place, Income Tax Act is in place, or a couple of other laws. But if we see, there are many other laws which are there, which are directly or indirectly affecting the industry. So one is, so though I have stated the regulation, the one of the important aspect here is the guidance note. So guidance note for accounting on real estate, this is applicable in case of those entities which are following IGAP. So this was issued in 2012. It's one of the write-up or one of the hello. Yeah, I think the line is it visible now? Yeah. So the major regulations comprises of Real Estate Regulation and Development Act, which we call briefly as RERA Act. So this came 5 years down the line. 5 years back, this came into existence, and this helped a lot to the industry to get its position consolidated. And the good players, the large players in the industry got structured themselves. And this is one of the key regulation which will also be helpful for the auditors, for the customers, for the regulators, for everyone to have more transparency in place. Indian Contract Act, again, it is relevant because there are contractual arrangement to buy or sell properties. Transfer of Property Act, Registration Act, Indian Stamp Act, Income Tax Act, GST, Companies Act, Urban Land Ceiling Act, Land Acquisition Act, Rent Control Act, FDI guidelines for real estate, LODR, in case of listed company. Some of the key terms which we broadly use in real estate, we may be using it in our further slides. Those are brief acronyms. So I'll just touch upon FSI means Floor Space Index, which is like how much is the developable area available on a particular land bank. BHK is bedroom, hall and kitchen. TDR, transferable development right. LOI, letter of intent. OC, occupation certificate. CC, commencement certificate or completion certificate. CDP, comprehensive development plan. Carpet area, built up area, super built up area. Carpet area means, all these, some of the terminologies are being described or defined in RERA Act. So carpet area, built up area, super built up area. When a customer goes and buy the property, the dealing normally happens or the pricing normally is being decided on the basis of super built up area. But as per the RERA regulations, in the sale agreement nowadays, it is a mandatory requirement to specify the carpet area, what a customer is getting, and customer should be aware of that particular carpet area. Major risks which are there in real estate industry and mitigation of the risk. So major risks are like regulatory approvals and clearances. So if regulatory approvals are not received in time, it will impact the timeline of the construction of the project. Interest rate risk, if the interest is increasing steeply or it's declining, I mean, again, it's impacting my project because most of the projects are being funded by having the borrowings from the banks or financial institutions, or even the sale will also get affected. Customers may or may not get inclined if the interest rates are higher. Pricing of property, if the property is not appropriately priced, again, the demand will get affected. Inflated land prices and cash transactions. So if the land prices are on a very high side, ultimately it will affect my overall cost of the project. And element of cash transaction, as we know, I mean, in this sector, there are probabilities and this is one of the risk or I'll say one of the risk factor in this particular industry or in this particular area. Though after RERA coming into picture and GST coming into picture, a lot of things have got streamlined. But in the past, I mean, this was one of the key risk factor. It is still there, but it has reduced to a good amount. Facilitation payments, ambiguous or sale purchase agreement. So if the agreements are not very clearly or descriptively drafted, I mean, this will again have a concern. Related transactions, land aggregators, clear title of property. The title of the property is not very clear. I mean, there are disputes or litigations and still the construction is going on. So these are some of the risks which are involved in the real estate sector. The manner in which the risk can be mitigated, I mean, here we will touch upon that. So development of a risk management framework. So a risk management framework should be there. And in case of companies, wherever IFC is applicable, so IFC is internal financial control, risk control matrix also should be prepared. That will also be helpful to understand, to evaluate the entire business model of the company, the transactions, the key transactions of the company with regard to sales, with regard to purchase of material, land bank, etc. Disbursal based on milestone and regular site visit. So the disbursals are being done on timely basis as and when the milestones are completed, and we regularly visit the site. So I mean, one has to. So if one who is doing the audit of the financial statement should at least try to visit once in a year a particular site of a project, so that there is a clear understanding that what is being demonstrated in the books of accounts apparently appears to be in sync with the cost which is being incurred and the project which is getting completed in terms of percentage completion on that site itself. Use of data analytics to record inventory, expense, payment, progress report, etc. Periodic audits. So if the audits are done on timely basis, so again, internal audits. So if internal audits are done on timely basis, quarterly, half yearly, I mean, this will again help to the management to identify the gaps and to take the corrective actions within the prescribed timelines. Restriction on cash transactions. So now most of the developers have moved on to the banking mode for collecting the cash. I mean, for collecting the consideration. So that is really going to be very much helpful, and it will reduce the risk of cash element in any of the real estate development project. Strong legal and compliance team. So if there is a strong legal and compliance team, this will also help the management to mitigate the risk arising on account of litigations or to enter into the litigative deals if unknowingly they are entering into it. So large real estate developers do have a good amount of legal or professionals within their ambit who work as an employee or work as a professional or as a consultant to them, and they advise and they guide to them on the required set of transactions on time-to-time basis. Training on legal terms and update on real estate regulations. So as we know, real estate regulations are also changing frequently. So one has to be getting well versed with the real estate laws, training on the legal terms and effective internal audit, which you have discussed. Now, in this slide, we will just touch upon a certain set of development agreements. So what kind of development agreements can be there? So when I say development agreement means a joint development agreement kind of stuff. So for example, there may be a possibility that price of the and has acquired the land. So that is quite simple. The second is sharing of revenue. Another model is that the understanding between the landowner and the developer. So here, I mean, to describe in more detail, in these kind of arrangements, what happened that there is a landowner. I mean, landowner may not be very much well versed with the development activity, but the landowner has a good amount of land bank and the developable FSI. However, because of the absence of requisite expertise, the landowner will try to find a developer to construct a project. And developers are those experts, I mean, who have that experience of developing the real estate projects. They had good amount of expertise based on their past trends, and they have that capability. They have that understanding how to develop a real estate project. So here, I mean, both meets together and they try to develop a project. So the second category is sharing of revenue. So here, what happens that the landowner will say that, okay, I'll give you the land bank, but I'll not require any monetary consideration right now. But then there may be a understanding between the landowner and the developer that as and when the revenue will be realized, so there may be an understanding that the revenue has to be segregated in the ratio of 30:70 or 20:80, for example. So if a particular unit is sold for 1 CR, if the understanding is that 20% will be transferred to the landowner and 80% to the developer, so then 1 CR will be collected by the landowner and the 20%, that is 20 lakh rupee, will transfer to the landowner, and 80% will be transferred to the developer. So the amount will be collected by the developer, not landowner. So this is a kind of sharing of revenue model. So I mean, on this basis, as and when the collection will happen, the disbursements will be done to the landowner by the developer. Third category is sharing of profit. So here the revenue is not being segregated or being asked for, but the profits are being shared. So kind of association of profit or a kind of arrangement between a landowner and a developer. And the fourth is that there will not be any sharing of revenue or sharing of profit. However, there will be sharing of some area when the project is completed. So to give an example, what will happen, like if there is a multi-story tower of 40 floors which is getting constructed by a developer on a particular land bank, there is an understanding between the developer and the landowner that out of 40 units, I mean, comprising 40,000 square feet of developable area, 10,000 square feet of area will be given to the landowner, or maybe like 10 units will be given to the landowner. So then in that case, the area, once it will be getting constructed, will be handed over to the landowner. And in between also, if landowner wishes to sell those units, can sell those units if a buyer is being found by the developer or the landowner. So these are the four different models which are there. Why redevelopment is needed, or why it is required from the perspective of the customers. So I mean, the customers feel that the building is old, so a new building will get created. So this is a kind of redevelopment. We have discussed about the joint development. Redevelopment means there is already a building or a structure which is there on a particular land bank. However, the the building owners feel that there is a need to redevelop the building, need to demolish the existing structure and create a new structure. So that is called as a redevelopment. So in redevelopment, I mean, the old building will get demolished, a new building will come into existence. So that is one of the benefit to the existing owners of that redeveloped property. Left with unutilized FSI. So many times it happened that the earlier building which was constructed in, for example, 1950 or 1970, for example. And there is a good amount of FSI which is available over a period of time because of the area which is there. However, that is still not being loaded on that particular unit. so that FSI can also be consumed. Payment by developer of an amount to the society. So developer will also give some kind of purpose to the society. So that will be one of the benefit to the society in case of redevelopment. An extra area of for members without liability. So there will be extra area which will be available to members, which will be there. There will be some difference. So there may be some liability which will arise with regard to GST. In future, I mean, once that area will be given, our stamp duty and registration fee will not be required per se. Redevelopment benefit for the developer. So the benefit will be that the land bank is available in a good condition. The land bank will be available in a good location. That will be one of the benefit which will be available to the developer. The land normally requires a large amount of capital investment. In case of redevelopment, the investment will not be required because the structure will be recreated again. It will be given to the existing owners and the additional units which are going to get constructed by the developer, that will be available for sale to the developer. That is one of the already developed areas. So, I mean, there are very less chances or negligible chances that there will be any litigation on that. There is no need to form a society again. So these are the few benefits in case of redevelopment. Now, I mean, coming to the main crux of our presentation, key considerations of our audit. So till time we have discussed in brief about the background of real estate sector, the risks which are involved in real estate sector, the mitigative factors which you can take, and the kind of different structures or different model in case of real estate sector. Key considerations which we have to evaluate or to consider while one carries out the audit, or even relevant from the perspective of management. I mean, they have to be vigilant and they have to take care of these matters on suo motu basis, so that anything does not get stopped up at a later stage on account of the described facts. So one is about brokerage. So brokerage, I mean, so I'll share my practical experiences on all these matters, which we are going to touch upon in key considerations. So brokerage have generally observed that in many of the real estate entities, they capitalize it as a part of inventory. So they inventorize the cost of the brokerage with the inventory. Well, this is not the correct requirement of the standard. So the standard says that as and when only those costs can be inventorized which are related to the project. So those costs which are not related to the construction of the project, those costs which are related to the marketing or selling activity of the project are not required to be capitalized or inventorized. Those costs are required to be charged off to P&L. So in these cases, such kind of brokerage costs cannot be inventorized. However, the treatments are different in IGAAP and Ind AS. In IGAAP, the brokerage cost is required to be charged straight away to the profit and loss account. In Ind AS, whereas in Ind AS, it can be deferred over a period of time based on the required parameters. So there is a difference between IGAAP and Ind AS. However, this will not get form part of inventory. This is one of the important things because it is a cost which is related to my selling and distribution and not related to my construction or the development of the project. Sample flat, again, I mean, if we see the many times the cost is incurred by a developer to develop a sample flat, so that may be in an adjoining area near to the project. And that is constructed only for a certain set of time. For example, if the project is going to get completed within a period of 8 years, I mean, that's the estimated timeline, and the sample flat has been constructed, but then the management intends that after 4 or 5 years, this sample flat will be demolished, and that particular land bank area will be used for some other activity, maybe for some playground or for some other construction, etc. So in that sense, if we see sample flat as something which is not required to be loaded into inventory, it has to be shown separately. Again, it is related to my sales and marketing. So here, I mean, it can be capitalized as a part of PP, and the amount can be amortized by way of a depreciation in the profit and loss account, but that cannot be capitalized and that cannot be inventorized and loaded in my respective inventory. So again, because this is not related to my cost of construction of the respective project. Then related to this, selling and distribution costs. So there can be other selling and distribution costs. So one has to be vigilant enough and to see this, that those selling and distribution costs are not loaded into inventory, and those costs are charged to profit and loss account. Then, friends, an immovable property can be classified into 3 categories. So it is very important when we do audit of a real estate company. So a particular unit or a particular landmark can be categorized into 3 different categories. So immovable property can be classified into 3 different segments, as we know. One is inventory, second is PP, which is property, plant and equipment, and third is investment property. So when a project will go into inventory, a project will go into inventory. A project will go into inventory when the intent of the management is to develop and to sell the project. So when the intent is at that time, the particular developable unit will be classified as a part of inventory. Whereas a particular unit which is being constructed for the self-usage, for example, if a building is being constructed by a developer itself, but that building is going to be the corporate house of the respective developer. So in that case, that particular building will be classified as a part of PP and not as a part of inventory. Third thing, in many circumstances, we have observed that there are large real estate developers who develop the inventory. However, they don't have an intent to sell that particular inventory. So when I'm using the word inventory, I mean, they are developing a particular project, they are developing a particular land parcel, but they don't have any intent to sell that developed unit in near future, and they have an intent to earn the lease rental income by leasing out those developed units. So there are many developers. So in that case, those units or those constructed, developed or those constructed or developed property will be considered or classified as a part of investment property. So this classification between 3 different categories is very much important, and very, very careful evaluation is required, because the recognition of revenue, the taxability, the amortization, everything is being linked to all these different classifications. So it is very much important from that perspective. Then, friends, we should see this, that carrying value of inventory cannot comprise unrealized profit. So what will happen? So in the above situation which we were discussing, so if there is an inventory which is there in the books of accounts, that inventory can get converted into fixed asset. So as we know, I mean, in income tax or even in the practical scenario, in most of the real estate projects, there can be a possibility that the capital asset is getting converted into stock in trade, or vice versa, stock in trade is getting converted into capital asset. So, for example, inventory, which is a stock in trade, which is getting converted into a capital asset, the treatment will be different, the implications will be different. Whereas vice versa, a capital asset which is converted into stock in trade. So when a capital asset is converted into stock in trade, the taxability will arise on that converted stock in trade at a later stage as per the provision of Income Tax Act. That will be determined and computed upon, but will be paid at a later date. But one important thing one should keep it into consideration, that when a capital asset is there, so when I say capital asset, it was a PP, for example. In India, we know that PP can be recognized at cost or fair value, whereas in IGAAP it can be only at cost. So in IGAAP, if it is at cost, and for any reason, if someone has revalued the PP, and there is a revaluation gain which is there, and later on, so for example, if 2017 someone has revalued the PPE, and that PPE is still coming into my books of accounts as it is. So I'll say PPE means like land parcel. So I have purchased a land parcel in 2017. I had no intent at that point of time to develop the project and to sell it. I had kept it as a part of PPE. There was some revaluation which was carried out at that point in time, which was done according to the requirement of accounting standard. However, in 2022, the land parcel is converted from PPE to inventory. Now, when I convert it in books of accounts, I'll convert it at its carrying value, which is comprising the unrealized profit on account of revaluation reserve. So here one has to be very much careful that in IGAP, this kind of treatment cannot be given in case of inventory, because inventory will be comprising of unrealized profit. And AS2 is very much clear. AS2 says it clearly that the carrying cost of inventory should be at cost or NRV, whichever is lower. So here, this is not a cost. There is an element of fair value, valuation gain, which is involved into this. And this cannot be considered there. However, in Indes, there may be a probability that once the PPE is fair value, so that is being allowed. So once a PPE is being fair valued, it can be transferred to inventory at the same particular value. And then in inventory, that value can be carried out. So there will be a distinction between IGAP and Indes, and the treatment will also differ accordingly. And taxation also, we discussed that there will be tax implications, how it's being determined. So the classification and segregation of a particular land parcel or a project between all these three different categories is very much important. Then rehabilitation costs. So rehabilitation costs is something which is being considered as a part of land cost. So friends, if we see, we have discussed that guidance note on real estate will be applicable. So what is happening at present? In IGAP, there is an accounting standard 9, which is applicable with regard to revenue recognition, but it does not deal or specify so explicitly with regard to the transactions being required to get recognized in real estate industry. So it touches upon, and then because it touches upon, the guidance note has been issued by ICI to elaborate that particular noting in much of the detail, and there they have come out and they have described explicitly that when the cost can be recognized in the IGAP financial statement as per the guidance note as a part of project cost in P&L. So the percentage of completion method has to be followed. So when that method can be followed and when the recognition can start, that has been specified in this particular guidance note in much of the detail. And this guidance note also clarifies what kind of costs will be covered into the inventory, how the revenue will be recognized at what thresholds the trigger point should arise, and how the provisioning should be done in case if there is an impairment. There was also a guidance note which was issued with regard to those companies who are following Ind AS. However, that guidance note was withdrawn once Ind AS 115 came into existence. So from 2018-19, I mean, that guidance note on real estate in case of entities following Ind AS has been withdrawn. So this is one of the key change between IGAP and Ind AS. IGAP deals in detail and IGAP specifies explicitly that percentage of completion method should be followed, whereas Ind AS describes both the method. So one is called point over time and second is point in time. So in nutshell, if we say either percentage completion or project completion, so Ind AS gives both the option. However, based on so when I say both the options, the documents are required to be evaluated. The facts and circumstances are required to be evaluated based on the evaluation of documents and based on the evaluation of facts and circumstances. I mean, it can be concluded that whether the project completion method has to be followed or percentage completion method has to be followed in case of those entities which are following Ind AS. So if we see, friends, in general, most of the entities who are following Ind AS are following project completion method. because they are not triggering or meeting certain criteria which are prescribed by Ind AS 115. However, in certain cases, I mean, some of the developers are able to meet those requirements and they are following project completion, percentage completion method. So this is one of the key aspects of differentiation between IGAP and Ind AS. So Ind AS, we know, I mean, those companies which have a particular threshold of net worth and all, so to them, it will be applicable. And rest to all entities, IGAP will be applicable. So I'll say, I mean, even in case of partnership firm or LLP, the IGAP will be applicable if they are not forming part of the group where Ind AS is applicable, and they are supposed to be considered as a part of consolidation. So in IGAP, when the financials are being prepared, I mean, one of the key component again will be the rehabilitation cost. So rehabilitation costs will be considered as a part of land cost and not as a part of construction cost. And due to that, even though that cost is being incurred, that will be not being considered to reach the criteria of 25% threshold. So this is one of the key component in case of IGAP set of financial statement. So when I say rehabilitation costs will be comprising of many things. So for example, we just discuss on the redevelopment part. So in case of redevelopment, I mean, till the time that building is getting reconstructed, we shift the occupants of that particular building from that particular building to a different location. So the cost which the developer will have to incur to demolish that particular building or to have certain set of clearances and to pay rental to those tenants. I mean, those kind of costs will be considered as a part of rehabilitation costs, and it will be forming or categorizing as a part of land costs. Then another important thing is there are many real estate entities who are following IGAP right now, and they will get or they are getting migrated to Ind AS because of various reasons. So one of the reasons can be that they have met the threshold criteria, which is prescribed in Ind AS, or they are going for IPO, or they have become subsidiary or the joint venture of any company or any group which is following Ind AS. So all these things will be relevant. So here what will happen? If we see in IGAP, we were following project completion method. However, when you follow Ind AS, I mean, it has to be followed as per, in IGAP, we were following percentage completion method. And when we will follow Ind AS, we will follow project completion method in general. So what will happen? That revenue which was recognized in IGAP will get impacted. It will require a reversal to some extent. There may be a possibility that a reversal will be required if the criteria are not being met in Ind AS. So that will be one of the important things which one has to keep it into their consideration when the financials are getting migrated from IGAP to Ind AS. And again, there are mixed approaches, retrospective approach or modified approach. So the impact will have to be given in the reserves and surplus. Estimated cost. So in IGAP, I mean, the entire substance of recognizing revenue in IGAP is based on the estimated cost. So while doing audit of any IGAP set of financial statement in case of real estate sector, one has to look into detail the costs which are being estimated by the management. So as an auditor, one has to run through those costs. Even management should look into the costs which are being planned upon by them based on their past experiences towards the various projects. So why it is relevant? It is relevant because my entire percentage completion method is based on the estimated cost. So for example, if I estimate cost of a project as 1,000 crore rupee, and if I have completed, if I have incurred 300 crores till time, so which means my 30% project is completed. So if my 30% project is completed, my revenue recognition will trigger under IGAP, and I'll have to recognize the revenue. Whereas vice versa, I mean, if management does not intend to recognize revenue, I mean, it's just an hypothetical situation. that if management does not want to recognize the revenue, maybe knowingly or ignorantly, I mean, if the costs are estimated as 1500 crore rupee, and we have incurred 300 crore rupee as on the balance sheet date, the criteria or the threshold will not be met, and we are not triggering or recognizing revenue. So many a times it happens, or there is a possibility that the management will be more keen to recognize revenue on the basis of project completion method, because there is a deferment of income tax to that extent on account of that, and they will not be inclined to follow percentage of completion method. So the estimated cost will play a vital role here. If the estimated costs are estimated on a very high scale as compared to the size of the project, my threshold will be deferred, and the revenue will be deferred, and my tax liability will differ accordingly. And on the contrary side, I mean, if it has been reduced to a lower side, my revenue will shoot up significantly. So one has to look into it diligently and took a fair approach, a fair call, that how the estimates are being determined by the management with regard to cost, how they have factored the inflation or the other parameters into it. And those estimated costs should be only and only related to the development of my project costs, and it should not include any estimated costs with regard to sales or marketing. I mean, again, this is one of the important criteria. So, as an auditor, I mean, one will also have to see, and one will have to request the management to verify those estimated costs maybe at the management level, so that the authenticity is there. And it should also be seen that the estimated costs are being revisited regularly. So when I say regularly, means at least once in a year, so that if there are any further incremental costs or escalations which are required to be factored, that can be factored on a timely basis. It should not happen that if a project is having a life of 6 years for getting developed, the entire differential cost is being identified and recognized at the end of 6th year. So after first year, there is never a revision in estimated cost. So we estimated 1000 crore in the first year, and by the end of 6th year, it became 1300 crore or 1400 crore. It should not happen that 400 crore cost comes up and get parked all of a sudden in the books of accounts in the 6th year itself. So this estimation plays a vital role, very, very significant role in case of those entities which are following IGAAP set of financial statement. Friends, now, I mean, there may be a possibility, as we know, I mean, as we have stated, we have seen here that the costs are required to be revisited on annual basis. So there may be a possibility that in the year one, when the costs were estimated, they were estimated as 1000 CR, but maybe because of change in the plan, change in the design, change in the layout, or change in the ambience, or whatever reason, I mean, the costs have increased. So there may be a possibility, and if the costs have increased, I mean, that will lead to a change in estimate. And as we all know, there is a accounting standard. There is also an index which deals with change in management estimate. So change in accounting estimates are required to be disclosed in the annual accounts by the management, and auditor will have to see, will have to look into this, and will also have to clarify what kind of impact such change in estimated costs will be there on the current set of financial statement and in the future set of financial statement. Again, I mean, this has to be looked from the perspective of materiality. Whether such change is material, immaterial. I mean, those factors are also required to be considered, but this is one of the required element. So it will not be a change in accounting policy, but change in management estimate, change in accounting estimate, and it will require adequate disclosure. In case of listed companies, again, I mean, the accounting policies are required to be disclosed at the end of every quarter's results as per the LODR guidelines. Whereas the estimates are not required to be disclosed in the quarterly results. So in case of listed company also, if there are change in management estimates, and those entities which are following percentage completion method under index, they will have to disclose change in management estimate at the end of the year in their financial statement, along with the description about the impact which is going to be there in future period and is there in the current period's financial statement. So these are some of the key factors which were described in this particular slide. We'll move on to the next slide. Interest cost capitalization. So friends, again, I mean, one of the key factor here will be the capitalization of interest costs. So when an interest cost should be capitalized in the land bank. So one has to take a pragmatic view, a practical call, and looking into the facts and circumstances. So the interest cost can be capitalized in a particular unit which is getting constructed as per the standard on borrowing costs, either in ICAP or Ind AS, only and only when that is in the nature of qualifying asset. So if an asset is a qualifying asset, if those parameters are being met, then only interest cost can be capitalized. So there can be two school of thought, or there can be two set of facts which can be made available to the auditor or to any external party by the management. One is that the land has been purchased. However, at present, management does not have any intent to construct that particular to construct a project on that particular land bank or to develop that land bank. Management has just acquired that land bank. It will be evaluated by the management in near future that how they will like to move ahead with this particular land bank, whether they would like to trade and sell it as it is, or they would like to develop it. So till that time, so for example, in 2015, if a land bank has been purchased and management does not intend to develop a project on that, then in that case, any interest cost incidental to that land bank, I mean the funds which have been borrowed, that interest cost will be charged to profit and loss account because that land is not a qualifying asset. However, if it can be demonstrated by the management, it can be proved, and there are facts and circumstances which are available through which it can be demonstrated and stated that the land bank which is purchased by the management is going to be developed soon by the management, and the relevant process with regard to planning, designing, seeking approvals, etc., has been commenced from the management side, and the intent of the management is to develop that land bank and to sell it in near future. And all these things are there; these facts are available. Then that land can be called as a qualifying asset, and the interest cost can be loaded into that land bank and can be capitalized or inventorized along with that particular land bank. So this is one of the important things. When to capitalize a running project. So we discussed that then there can be a general borrowing cost or a specific borrowing cost. So as we know, there are two sets of borrowing costs. One is specific borrowing and second is general borrowing. So for example, if I have a land bank in a particular area, so if I need to develop a land bank in a particular area and I have specifically borrowed a loan for that particular project, then whatever interest costs I am incurring for that particular project, I will have to load it into that particular project. That is the requirement of the standard. Whereas if I have general borrowing, so for example, the company has issued debentures and had raised funds or had general purpose corporate borrowings, then in that case, the general borrowing costs are required to be identified and segregated on the basis of weighted average cost method as specified in the accounting standard or Ind AS, and it has to be segregated and allocated to the different projects if there are multiple projects, and to load those general borrowing costs into the respective projects. Here, the relevance will be again if we see advance from customers. So advance from customers will not have any role to play if the borrowings are specific in nature, because the entire interest cost is required to be loaded. However, in case of general borrowing costs, that will play an important role because we will have to adjust those advances from customers. One has to see and consider that these are the amounts which are generated from the respective projects and which are being deployed towards that respective project, and accordingly the loading of my general borrowing costs will be on a lower side in such circumstances. Again, it has been seen that many times management intend not to inventorize the interest cost or to charge the entire interest cost to P&L. So it's not a will and wish of the management. It depends upon the facts and circumstances which are available and the nature of an asset, whether it is a qualifying asset or not, and accordingly the interest cost will be capitalized or will be charged to profit and loss account. So this is very important, and as we know, the borrowings play a major role in case of any real estate development. So this will be impacting straight away to the profit and loss account. Another thing, once the project is completed, so once I have received the OC, and if still I have a borrowed loan with regard to that particular project, then in that case, I will have to charge that interest cost to P&L, because once the OC is received, once the project is completed, I cannot load further costs into my inventory. I mean, all those subsequent costs will have to be charged to profit and loss account. So again, one has to be vigilant and aware of, and to advise management appropriately to take corrective steps. It has been observed that even subsequent costs are getting added to inventory, which are considered as a part of finished goods and not as a WIP. So that should not be the treatment which should be given to the interest cost or any other incidental cost, even though it pertains to the development of my project. Once the project is completed and it's transferred to FG, the costs are required to be charged to P&L. Another important aspect here is if the borrowed funds are parked temporarily. So many times it happens that at the end of the year, the funds are borrowed. So for example, on 15th of March or 28th of March, our management still intends to or is still evaluating how to deploy or how to incur that cost, or they have not yet incurred the cost. They have plans to incur the costs in the near future in the next couple of months. So till that time, they are parking those borrowed funds in the fixed deposits or any other instruments, and they are earning some income out from that. So such kind of income are required to be reduced from the respective projects cost, and the project cost should be determined accordingly. It cannot be transferred to profit and loss account. Another important aspect here is interest cost charged by parent to subsidiary. Friends, what happened here that many times it happened that the parent company funds to its subsidiary company, and parent company charges X amount to subsidiary company. I mean, so for example, if 100 crores are being lent by parent company to subsidiary company for developing a particular project, and the rate of interest charged by the parent company is 10%. So it may not be a wholly owned subsidiary. It may be 70% or whatever the case may be. But then the interest is being charged. It's not an interest-free loan. So in that case, parent company will recognize 10 crore as an interest income in its standalone financial statement, whereas subsidiary company will recognize 10 crore as a part of its inventory cost because it is having a qualifying asset in its books of accounts and it has borrowed funds for that. However, what will happen when we'll do the consolidation? So in consolidation, if we see, I mean, again, there are mixed practices which are prevailing in the industry and between different caps. So in IGAP, the most of the players in the industry are recognizing or reversing those interest incomes and interest inventory costs from the books of accounts and are charging to P&L accordingly, appropriately, because these are intergroup transactions. Whereas in certain cases in India and all, I mean, in certain set of companies, I mean, they took a pragmatic call that the funding is being done at a group level, on overall group level. There is no element of spread which is involved into this. The parent company had borrowed it at the rate of 10% or maybe, for example, 9.5%. So if it is 9.5%, so then they will reduce 0.5% to the extent of the spread in the consolidated financial statement. So they will say parent company A Limited has borrowed funds from HDFC Bank, which is of 100 crore at 9.5%, and it has lent to company B, which is its subsidiary, at 10%. So 0.5% they will reduce it and they will reverse it, whereas 9.5% they will continue it. They say that ultimately it's getting transferred and loaded into my inventory. So at group level, it will be shown as a part of inventory. Whereas the another set of thought is that it will not comprise there and it will have to be reversed. So what will happen? This will be only a kind of timing difference in nature. And as and when the revenue is going to get recognized, in case of, for example, percentage of completion method, the cost will get recognized if it is not reversed, and if it is reversed, it will not get recognized. It will recognize at the end of the completion of the project. So there will be a deferment to that extent in the consolidated financial statement as compared to the standalone financial statement. So one has to be again very much careful and evaluate the facts and circumstances, on what basis and what intent, on what background the costs are being charged, those costs are being loaded, and whether they can continue in the consolidated financial statement in the inventory or not, or such kind of transactions are required to be removed as a part of intercompany eliminations. Then in some cases, project area is, it also happens that in some cases there are some spaces which are available in a large project. So suppose if there's a large project which is getting developed and still there's a good amount of land bank which is still lying plain or vacant. Many times it happens that the developer give it on rental basis, maybe to a cement company who will deploy a cement clinker there. So that cement company so for example, it will be rented out to Ultratech. So Ultratech will deploy a cement clinker machine there. They will manufacture cement and they will also supply to the management, to the respective company, and they will also sell it to the third party. And so when they sell it to the third party, they will earn some kind of income, and out of that some commission or something will be given to the management. So in that case, that again is a income which is required to be reversed from the total inventory cost of the relevant developer's inventory. Respective inventory, it will be reduced. Then here one should also be very much careful now, as we have discussed that in our earlier slide, as we have discussed that RERA had come into existence. So RERA, Real Estate Regulation and Development Act. This is an act which is prescribed by the central government. Different states will have different rules. So different states will have something different to another state. However, everything will be within the range or purview of the act which is prescribed by the central government. So here one will have to be cautious so if one who is auditing the financial statement of a real estate company should seek the details which are being submitted by the management to the real estate authorities. And those details will be very much helpful while doing the audit of that particular entity. So to identify and verify the details of sale units, how one can know that how much units have been sold and what is the sale consideration. So if we see when the details are being submitted to the developer, to the regulator, regulator asks the developer to give the details on quarterly basis, at least on quarterly basis, that how many units are sold, how many units are unsold, the units which are sold, what is the sale consideration, to whom it has been sold, what is the carpet area, etc., etc. All these details are required to be given. So there may be a possibility, again, the consideration received towards the unit sold as of only 20% or 25%, 75% is the balance amount. So one can easily verify how much is the revenue, the collection which is required to be collected by the developer, and how much units are being sold by the developer, and the advances which are collected by the developer towards a respective project, and whether it is mapping with the advances which is being shown in the books of accounts. So if it is not, then there is a disconnect to that extent. So this will be very much relevant. And again, this will be relevant from the perspective of recognizing revenue in case of those entities which are following percentage completion. So I'll say, for example, in case of Ind AS or in case of IGAP, when percentage completion is being followed, the sale consideration again will be relevant. The advances collected will play a major role there for recognizing the revenue. So from the data submitted to real estate authorities, one can verify and cross-check it with the books of accounts and see that both the things are in sync. I mean, apart from this separate and independent assessment and testing, this can be one of the additional aspects to consider to have the comfort from the auditor side that the details which are appearing in the books of accounts are in sync with the details which are submitted to the regulator. Then price variation in units. So again, there may be a possibility that there's a good variation in price. So that can also be very well identified and observed by the auditor. So if one sees the trend, so like in case of a listed company, one sees the trend, or in case of unlisted company, so like in last 3 months or in last 6 months or in last 12 months, how many units have been sold and what is the per square feet area, I mean per square feet sales price which is charged to the customer by the management. So if there are heavy fluctuations, auditor can ask or should ask to the management that what are the reasons for heavy fluctuation. So for example, there can be reasons also, but then one has to be careful enough to evaluate that whether those reasons are appropriate or not, or is there any element of cash involved into this. So this will also help you to identify and to evaluate that whether there are any cash element or cash components which are there in any kind of sale considerations. So this is one of the tricky factor or one of the risky factor in the real estate, which was there in the past on very higher side, but now it is getting reduced to some extent. So how you will verify? So you will have to take care. You will have to see that. So for example, in the month of June 2002, when the sales took place, the per square feet rate was, for example, 15,000 rupee for that respective unit. However, when the units which are being sold in the month of August or October, the per square feet rate is 10,000 or 12,000 or 14,000. So there can be a nominal difference. The possibility can be that because of some additional considerations which are being given by the developer to that particular customer, or some leeway in the milestone payments, etc., there can be some or certain set of reasons. However, if the variation is quite large, so when we are discussing here in this example, if that is 10,000 rupees and 15,000 rupees, then it gives an indication that there is some element of cash which is involved there. And again, if there is a bounce back in the month of December or January to somewhere near to 16,000 or 14,500, then there is a strong sense to identify and to understand what are the reasons. Auditor should understand from the management and should document accordingly and should conclude it that whether any different component is involved into such kind of pricing or not. And again, this can be very well evaluated, identified, and mapped with the data which is being submitted by the developer to the real estate regulator. Unsold inventory, again, this will play an important area. So the inventory which is being reflected in my books of accounts, the area of that inventory, I can map it with the inventory which is being disclosed and submitted to the regulator with regard to the unsold carpet area. So I can map it that both the things are in sync or not. And based on that, the cost which is there appearing in my books of accounts with regard to unsold inventory is appropriate or not. Estimated costs. So estimated costs will also play an important role here in case of withdrawing funds. As you all know, RERA Act has specified the criteria of 70% and 30%. So 70% funds have to be deployed for the respective project. It is to safeguard the interests of the customers of the respective project, and 30% the regulator allows the developer to withdraw and to use for the general business purposes. However, 70% funds which have been collected by the developer has to be utilized or deployed only for a respective project. So here what will happen if my estimated costs are estimated on a very low side, my percentage completion will be on a higher side and the developer will be able to withdraw more funds, or vice versa. I mean, there can be an error also, or the costs are estimated on a higher side and the withdrawals are happening on a lower side because my costs have not incurred to that extent, though I have collected higher funds. So the developer will have to wait. So here again, the estimation of cost plays a vital role in terms of withdrawing funds by the developer from the real estate designated bank account. Then, friends, Form 3 and Form 5, this will also be useful to evaluate certain set of details. So Form 3, as we know, as you might be aware, I mean, those who are from the real estate background or dealing with the real estate developers will be aware that Form 3 is required to be given when the cash is required to be withdrawn from the bank account, the designated bank account by the developer. So the point which we have touched upon in the immediate line item deals with that. And Form 5 is something which is required to be given by the statutory auditor. So here the regulator clearly says that Form 3 and Form 5 cannot be issued by the same chartered accountant. So Form 3 has to be issued by a chartered accountant who is not the statutory auditor of a respective entity, whereas Form 5 has to be certified only and only by the statutory auditor. So certain details which are vetted by the independent chartered accountant in Form 3 are also required to be vetted or cross-verified by the statutory auditor in Form 5 along with other relevant details. So the details which are being submitted to the regulator on time-to-time basis in Form 3 or Form 5 will again play an important role to cross-verify or to map it with the books of accounts and to understand that there is no dissimilarity or unsynchronization between both the sets of books of accounts, both the sets of records. Then, friends, till time as we know, there was no sales agreement template, no template for sales agreement which was prescribed by any regulator. And there were different templates which were being carried out or being used, different set of arrangement or agreements were being used by the developer. However, the regulator has come out with a model sales agreement. They have also prescribed the minimum set of details which are required to be captured in the model sales agreement. So this will also be one of the important things to see that the model sales agreement has been adhered to, and all the required contractual terms and conditions are factored into the sales agreement. It should not happen that certain terms and conditions which are required to be prescribed has not been specified in the model sales agreement or vice versa. And from model sales agreement, when it is a mandatory requirement to specify the carpet area. So one specifies the carpet area, one can identify how much is the carpet area of the project which has been sold. I mean, it can be plotted into an Excel sheet, and then it can be summarized and can be mapped with the books of accounts. So again, all these things will be helpful to the auditor while doing the audit. Registration of sales agreement, again, it has been prescribed that once the 10% consideration has been collected of the total consideration value of a respective unit, I mean, the agreement is required to be registered. In the past, we have seen that the agreements were not registered, and most of the units were being occupied or were being blocked by the investors. So the regulator was also losing GST on that part. I mean, sometimes, I mean, they will show it as a part of advances or loan, but they will block it and then they will sell it. So those kind of practices will get curbed, and this is a mandatory requirement. So the registration plays an important role, and this will also give a comfort to the auditor that okay, the agreement has been registered. So then POC method, when it is required to be applied, then it can be applied and the revenue can be recognized. Otherwise, there would have been a possibility in the past. It was happening that there was no need to enter into a sale agreement till the time the possession is given. There is only a MOU, memorandum of understanding, And based on that, the entire transaction was being booked and the revenue was getting recognized. And when the POCM was and the revenue was getting recognized through POCM over the stages, in those scenarios, the revenue was getting recognized. So, for example, in 2016, someone had just entered into an MOU with a customer. The revenue will be recognized on the basis of MOU on the POCM basis. Now, when the project is getting completed in 2023, in 2022, that particular customer will surrender its right and a new customer will come into picture and will buy out that particular unit. So what happened that over a period of time, the revenue was getting booked, which was not required to be booked. That was not in actual sales. So all these things will get covered when the agreement is getting registered. I mean, so again, this is more relevant. So one will say why a developer would like to recognize revenue. So this was more relevant from the perspective of a listed company when the quarterly results were required to be given. In case of unlisted company, the management will be more keen to recognize revenue on the project completion method. So the registration of sales agreement puts a lot of control on this kind of practices and activity, and it gives more comfort to the auditor or to any external party that by whatever means the revenue which has been recognized is recognized only for the customers who are actually existing. Even if it is in the nature of investment by an investor, I mean, that can be cancelled or surrendered at a later stage. That's a different thing. But at present, there's a contractual arrangement and the agreement which is there, which has been registered with the respective regulators. Then revenue recognition, we discuss about the IGAP. So IGAP, we discuss about POCM. So in IGAP, the guidance note clearly says that the revenue is required to be recognized with respect to a respective project, and project can be a cluster of project or can be an isolated building. So for example, if there's a large project which has 10 towers, the developer has a choice to identify and specify each tower as a separate project and to recognize the costs and revenue differently, or maybe a cluster of towers. So for example, tower ABC, they will say project 1, tower DEF project 2, and accordingly the cost and revenue will be recognized. So it depends upon the management, how they have defined it, and again in the RERA, how they have registered that. So RERA and the books of accounts again will be required to be synced in such circumstances to see that what is the nature of project, what will be called as a project, and what kind of costs related to a respective project will be getting charged to P&L. So if it's an isolated tower out of 10 towers, the costs accordingly incurred and revenue realized will be recognized accordingly. POC method will be applied on that respective tower. Whereas if it is a cluster of tower, it will be segregated accordingly, and cost and revenue will be differed accordingly. And if the entire parcel with the 10 towers is considered as one project, then everything will be recognized accordingly. So in that case, in such a large case, till that time that 25-10 threshold or the criteria which is prescribed by the guidance note in case of IGAP is not met, revenue will not be recognized. Whereas in Ind AS, it depends upon the parameters which are defined or described by the company in case of POCM. Otherwise, project completion basis, it will be relevant. So, friends, in case of POCM, this will be playing an important role. The identification of the projects and the registration of the respective projects with RERA authorities. In AS, we have discussed that there are two criteria, POCM or project completion, and it depends upon the management and the based on the facts and circumstances. It can be identified and evaluated which method will be more appropriate for recognizing the cost and revenue in the books of accounts. In project completion also, I mean, again, there are mixed practices in the industry. So some corporates will say, till the time we don't receive OC, we don't recognize the revenue. Some will say, till the time we don't receive substantial collection, maybe 90 or 95%, we don't recognize revenue. Some will say even higher than that, that it's a mix of both receipt of OC and receipt of substantial money, maybe 90%, that will be the threshold criteria, then only the revenue will be recognized. So in this case, for example, if the OC is received, but I have received only 70% of my collection, then that revenue will not be recognized. So it depends on how the management is identifying when the control is getting transferred, and accordingly, it should be documented appropriately and the revenue should be recognized appropriately. And the accounting policy should also be specified very clearly that what is the base of recognizing revenue by the management when a particular criteria is getting triggered. Impact of onerous costs, onerous contracts. So friends, what happened here, as we know that, as we have discussed, that many times it happened that the cost will increase in near future. Now, if the cost increases in near future and if it's a steep increase in the cost and it is straight away impacting to my inventory, to that extent, I mean, the IGAP says that the cost is required to be recognized in the books of account immediately. It cannot be deferred if it is with regard to the inventory which has been sold. So this is something which is very much important. Then transactions of non-monetary consideration. In our earlier slide, we have discussed about the joint development agreement. So as we have seen, there are different kind of arrangements with the joint developers, between the joint developers. So how the joint development agreement should be factored in the books of accounts while closing the books of accounts. So in IGAP, the treatment is silent. IGAP does not describe what should be the treatment in case of joint developer, and specifically in those cases where the landowner will be given certain consideration by the developer at the end of the completion of the project. So basically, if we see, this is a kind of transaction which is of a non-monetary consideration, or it's a kind of a barter transaction, where the developer will give the landowner certain units in the nature of consideration at a later stage once the project is completed. So IGAP is silent in such scenario, whereas in India's 115 is very clear. It says that it should be recognized, and so again there are different approaches. So one can be that the land can be recognized at fair value in the books of the developer, and then the entire mechanism can start. So that can be one of the option, or the second option can be the land. I mean, in place of land, the area which we are going to give, so we can determine some fair value of the construction cost. So actually what is happening, ultimately the construction cost is being incurred by the developer, and it's the unit which are going to be constructed. The construction cost of those units is the actually in the nature of consideration which is being transferred by the developer to the landowner. So it can be that the estimation can be done on fair value basis of the construction costs, and it can be recognized. So it will be recognized as an asset on one side and liability on the other side in the books of accounts. And in this case, the standard also says that then this will be the nature of rendering construction services, because the landowner will get the developed units. So developer is going to create some units in consideration and give it to the landowner, so that landowner can keep it with them or can sell it in near future. So, so this will be a kind of POC method. Here it will get applied, percentage of completion method, and this will have to be recognized in the P&L. So ultimately, what will happen? It will get grossed up on one side in the P&L. This will come up on the top line, and on the another side, it will come at the expenses line item, and then the net impact will be neutral to that extent. But then this is very much important. It has to be recognized and it has to be brought into the books. It cannot be kept as a off-balance sheet item. This is very much important. Friends, with regard to brokerage, one important thing is to state that many times it happens that the developer commits and agree to pay brokerage to the brokers once the entire, or once the particular set of milestones are being achieved in terms of collections, or there may be a possibility that there is no cancellation or clawback, etc. So in those cases, if it's being determined then the management will have to pay the brokerage and certain set of criteria has not been achieved. So for example, management says that till the time I don't receive 20% of sales consideration, I will not pay brokerage to the broker. However, through the referral of the broker, we have received some customers and they have paid 5%, 7%, whatever the amount may be. So in that case, to that extent, the brokerage amount pro rata should be considered or classified as a part of contingent liability because it depends upon a contingency. It may or may not happen. Ultimately, it may be a possibility that the buyer will cancel the transaction, the brokerage will not be paid to the broker, or there may be a possibility that the transaction will get consummated and the customer will be there and the brokerage is required to be paid. So it will not be pro rata, it will be full, but then the brokerage will require to be disclosed as a part of contingent liability. Then we will touch upon the subvention scheme. This is again one of the important things. We have seen this in the past many times. Developers comes out with various set of schemes. They state that you just have to pay 10% right now, or 20% or 30%. So it will be called as like 20/80 scheme or 20/20, 40 and 20. So something like that. So these are the different milestones. So in these schemes, what happens that you pay 20%. So if in case of 20/80, 20% you will pay right now, 80% you will pay it at a later stage. So these are all subvention schemes. So here, the element is required to be factored with regard to the interest component, and it has to be identified and segregated. The standard says it. So again, here a very careful evaluation analysis will be required to identify the component in such kind of subvention scheme. The educational material and the standard is also very clear, and they have specified in detail. So the educational material and ITHG touches upon these particular aspects with regard to subvention scheme. Multiple element or separate performance obligation. So there may be a possibility that there are multiple elements which are involved into any particular set of transactions. For example, renting services for clubhouses or other facilities which are being given by the management. So in those cases, if they are separately identifiable and they are separate as compared to the element of sale consideration, which is there with regard to sale of inventory, then it is required to be segregated and to be recognized separately. It cannot go hand in hand with the inventory, with the revenue which you are recognizing on inventory. Then, friends, another set of key area or the critical area is with regard to related party transactions. So as we know, as we have discussed that in the real estate, the structure is a large structure in general. So there will be developers who will have a large setup in place, and they will be having good amount of transactions within the group with the related parties. So maybe with the subsidiary, associate, joint ventures, or with the promoters or relatives of promoters. So these transactions again will require careful evaluation. And as we know, nowadays, regulator, maybe in case of listed companies, stock exchange or SEBI, are very much focusing on the related party transactions. Or in case of even unlisted companies, the regulators like MCA, etc., or maybe the income tax department will be focusing a lot on related party transactions. And such transactions are quite frequent in case of real estate because of their structure. So, for example, to give loan, to take loan, to give project advances, to sell land bank, to sell TDR, to buy TDR, to enter into a JDA. So these kind of transactions will be there. So it's important that we look into the requirements of the Companies Act with regard to approval of related party transactions wherever it is getting triggered. approval of audit committee wherever it is there, and approval of board wherever it is needed. And arm's length evaluation is something which is important. Based on that related party transactions, if we come across a certain set of transactions which are not fair, then we will have to state to the management to take appropriate corrective steps in those cases. Practically, it has been seen in such cases, in certain cases, that the plan to construct a tower is only of 20 floors, whereas the developer is still constructing the 4 floors above that particular tower, and it has been sold to maybe to promoters or to relatives of promoters or to known parties of promoter or to anyone else. So first thing, as an auditor, one will have to take a call that how it can be constructed, because it is a violation of law. So are there any plans from the management side? Are they selling it, or are they replanning the design and they resubmitting the designs, taking reapprovals from the regulators for constructing the excessive floors? So all these criteria are required to be seen, and then we have to see that the consideration whether, I mean, if it is at a lower side. So normally we see specifically in a city like Mumbai, as you go high, I mean, the sales price will be high. So if it is on a higher floor, why the sales consideration is lower as compared to the apartments or units which are being sold at a lower floors? So that distinction again will play an important role here for understanding and identification. Valuation of inventory. Valuation of inventory is again, these are all important factors, and this is one of the important factor here. As we see in any real estate company, inventory plays a major role, a major size of the financial statement or balance sheet of a respective entity. So inventory, one has to see that is there any diminution or impairment which is required in it or not. So one will say how impairment or diminution can be verified. So one has to be vigilant enough to see that the estimated cost which is there, so whether it is POCM or project completion. So if it can be, if it is established or demonstrated that the cost per square feet is higher than the sales price per square feet. So recent sales, if certain recent transactions which I have done. So if, for example, if I've done sales per square feet at 15,000 rupees, whereas my cost per square feet is coming at 17,000 or 18,000 rupees per square feet, this is giving a clear-cut indication that there is an impairment in the inventory which I am carrying, and that impairment has to be recognized immediately. So one has to be very much careful and to see that whether there is any impairment which is there in the inventory or not. Second thing, again here, another important factor will be that the inventory, whether which is being sold is lower than the ready reckoner rate or not. So as we know that the Income Tax Act has prescribed certain sets of rates below which a developer cannot sold units into a certain set of areas. So if the sales price per square feet is lower than the rate which is prescribed in the ready reckoner rate, it will be liable for tax in Income Tax Act. So from taxation perspective, this will be relevant. That though my sales consideration is on an average nearby to my past sales consideration, or it is higher than that, but in totality, it is lower than the ready reckoner rate. So then one thing again should be blinking to an auditor's mind, that is there any element of cash involved into this or not? There's a lower probability that the sales price will be lower than the ready reckoner rate. However, in some cases, there can be facts and circumstances which prevail, to which it can be justified that yes, the sales price is actually lower than the ready reckoner rate. So that evaluation will be very much needed, that whether any element of cash involvement is there or not. So though my sales price is similar or lower than that to the recent transactions, but in totality, if it is lower than the ready reckoner rate, there is an indication. So how to cross-verify this? To cross-verify this, one can see that what are the prices which are being charged in the similar area by the similar developer providing the similar kind of amenities. So again, a kind of arm's length assessment kind of stuff should be done to evaluate and to understand whether those prices which are lower than the ready reckoner rate are appropriate or not, are justifiable or not. Impairment testing of land. So we discussed that so there may be a possibility that a land is loaded with the interest cost. It is being called as qualifying asset, or a project which is loaded with the interest cost or is being loaded continuously. However, there has been significant delay. Earlier, the project was estimated to get completed in 6 years timeline, but maybe, for example, due to COVID or due to unavailability of manpower, the project is working on a very slow pace, and now it's going to take place for completion by 10 years down the line. So then there is a significant increase in the timeline, and this will ultimately add up the interest cost and other costs into that particular project. So in that case, again, there can be a probability or a possibility that the carrying value of my inventory in my books of accounts is higher than the realizable value or the sales value at which I'm going to sell it in near future. So this is something which is important. Friends, in case of large projects, I mean, now as we were discussing, there are large projects with the large developers. So when I say large projects, those projects will get developed over a period of timeline of 10, 15 or 20 years, such a huge land bank. Or maybe I mean short land bank, but then it will get, they will have 10 or 15 or 20 towers in that particular land parcel. So one has to see that the common costs are identified and allocated appropriately, and those costs are being loaded appropriately in the respective tower. So, for example, if material is purchased for tower A, it should be loaded with tower A or tower B respectively. It should not happen that material is purchased for tower A, but the cost is loaded in tower B or tower C. So this will be relevant again because the revenue is recognized on the basis of each project in IGAP, and in India's, I mean, from RERA also, the withdrawal of money will be relevant. So vice versa, I'll give an example. If project A is considered as tower A, and the cost is incurred for project B, but I have loaded it into project A, I can show the higher cost and I can withdraw more funds. So again, here one has to be vigilant and to see that the costs are identified and segregated appropriately between various projects and recognized in the books of accounts appropriately, because it affects my cash withdrawal, it affects my recognition of revenue. Then books of accounts should map costs related to respective project or tower appropriately with the regulators' data. In large project, there can also be a possibility that, so if I give an example, there's a very large project. In that large project, there's a possibility that that large project is being promoted and developed by the developer as a township project, where they will say that they will construct a clubhouse, they will construct a mall, they will construct a school, and they will provide all these facilities and amenities to the owner of the respective units. So in that case, intent of the management should be identified and evaluated by the auditor. The management should also assess its own intent, that what is their intent. Do they intend to construct a mall and then to run that mall on lease basis? If yes, then that mall building will be considered as a part of investment property straight away right from day one. It should not go as a part of my inventory. So the cost will require to get segregated between my investment property and my inventory. Whereas on the other way around, for example, for school, if management intends to run the school through its own trust or trustee or through its own management, so the ownership is still being retained, so then it will be considered as a part of investment property and it will be depreciated accordingly. Investment properties are also required to be depreciated. If it is not, then it will be considered as a part of inventory. So if the management believe that they will not retain the mall building or they will not retain the clubhouse, they will sell it to someone who is from the external group or any external party, maybe within the group. But then in that case, it will be considered as a part of inventory. So segregation between inventory investment property is important from the perspective of disclosure, from the perspective of depreciation, and from the perspective of loading the cost, etc. And this will also be an important factor to segregate, to make a segregation between different segments. So we'll touch upon that in our later slides. Then based on that intent, the auditor should request the management to make an appropriate noting, because the intent is as of date. Later on, there can be a change in intent, and accordingly, it should be documented and noted appropriately. Board should take notice of those facts, and the classification and the recognition of costs in the financial statement under the respective head will happen accordingly. Then TDS on sale of project, again, this will be an important thing. So when advances from customers are being received, it should be seen that the customers are deducting TDS at the rate of 1%. And when the customers deduct 1% TDS, it will appear in the Form 26A of the developer. So again, this will be a good kind of cross verification to map the advances which are appearing in the books of accounts and the advances which are shown by the developer and or which are being reflected in Form 26A by virtue of 1% TDS. So if one wants to cross-verify how much advances have been received by the developer during the year, it can be easily cross-verified. If there are differences, there can be a possibility of differences. Reconciliation should be prepared. So one of the reasons can be that the customer has not deducted the TDS or deducted not deposited, there can be different reasons, deducted or deposited in the wrong head. That's why it's not appearing here. But then once that reconciliation is there, we will also have the comfort that whatever advances which are there in that particular classification in the financial statement, and they are not being clubbed as a part of other payable or trade payable. Many times it is happening that it's being shown as a part of trade payable. So one should be cautious that the advances from customers are not forming part of trade payable. They are kind of other non-current assets. Then interest-free loan. So in case of interest-free loan, reporting under section 186 is not being triggered in CARO. But if the loans are interest-free, it will be prejudicial to the interest of the company. Evaluation should be done by the auditor and should discuss with the management that whether it is prejudicial to the interest of the company or not. If it is given to the wholly owned subsidiary, one can demonstrate it is not prejudicial, but whereas if it is given to partially owned or to a different entity, though it's exempted under section 186, the clause with regard to prejudicial to the interest of the company will get triggered. Treatment in Ind AS will also be different, because in Ind AS, even though there is no element of interest, notionally it is required to be considered and factored accordingly. Non-chargeable corporate guarantee, there can also be a possibility that the corporate guarantees are given by the parent company to the subsidiary company. So this will also have an implication if the guarantees are given interest-free. Recently, yesterday's newspaper, we have seen this, that GST department have issued notices to around 14 companies across various industries where GST has not been charged on the corporate guarantee, where no element of consideration is involved. So this is a litigative matter, but again, one should be vigilant and one should take an appropriate decision accordingly in terms of disclosure, in terms of considering the arm's length approval, recognizing the cost in the books of accounts, and obviously the materiality factor will also require to be considered here. Different models of real estate we have discussed: sale model, lease model. So in case of lease model, that unit or that particular project will be considered as a part of investment property. It will be depreciated accordingly. And as these are two different models which have different risk and return, they will be classified at separate segments, will be disclosed accordingly. Friends, again, the taxable treatment will be different. So practically, I have seen this in the past, that some of the developers, though they are leasing the unit, they are classifying the income as a part of income from house property, not as a part of business income. So ideally, if they are in the business of leasing out the unit and it's their model, then it should be considered as a part of business income, not as a part of house property. But again, there are mixed judgments, mixed precedents which are available. So appropriate decision should be taken by the auditor in consultation with their in-house tax team or the external tax professionals. What are the implications and what are the prevailing requirements with regard to it? And this will also have an implication in case of deferred tax. If it is classified as a part of house property, the difference on depreciation will not be available because it will be a permanent difference in Income Tax Act. Whereas if it is business income, then it will be available. So the impact in deferred tax will also arise on account of that segment we have discussed because of the different models. Loans and advances, impairment testing we have discussed. The another thing is about recovery and deployment. One has to see that when it is being given by the parent company to subsidiary company, where it has been deployed and how it will be recovered, whether any impairment testing is required for such loans and advances or not. Again, it will be based on the net worth of those respective entities. Investments in group entities also will require a careful evaluation from the perspective of impairment testing. Many times investments are being made, however, those entities' projects are still not working. So this will also play an important role for closing the financial statement of the standalone entity. Raw material, it has been observed and seen that though there are raw materials in the books of accounts or physically on the site as on the balance sheet date, they are not being segregated in the inventory apart from WIP. Everything is being clubbed into WIP. So it should be seen that if raw materials are there as on the balance sheet date, it should be segregated and identified and shown separately in an inventory between WIP, FG, and raw material. Then routing of funds through partnership form, again, through partnership model, the funds are being routed. Its deployment and impairment testing is very much essential. It is also seen that share of profits are arising from partnership form. So the standalone company is there, which is a good amount of investment in partnership form and good amount of returns are being generated from partnership form, and those profits are tax-free in the hands of the company because the partnership firm is not taxable for any of the reason, and any which is profits are taxable in the hands of the recipient. So now what happened that when you are certifying the standalone financial statement of the parent company and the amount of share of profit or share of loss is quite large, which is coming from the partnership firm financial statement which are not audited, your opinion is to a good amount of extent is being depending upon the figure which is being derived upon from the figure of partnership firm's books of accounts. So in that case, auditors should carry out independent processes, evaluate and to understand how the profit is being recognized, it's appropriate or not, and if required to make a mention in other matter or UM upon by stating that the reliance has been placed upon the books of accounts of partnership firm which are based on the management account or which are being audited by the other auditor. Deferment of revenue, there can be a possibility that the revenue is being deferred by, in case of specifically in case of project completion method, by not handing over the possession, though OC is received. So as we have discussed that the criteria can be that the OC is received, but the possession is not handed over, and then the revenue can be deferred. So auditor will have to see and will have to be vigilant. Will have to check the subsequent event recognitions also, that whether it pertains to the current year or not, and whether the deferments are happening or not. So similar thing is about substantial. So again, there can be a possibility that substantial money is collected. OC is received for more than 1 year. Sale agreement is also registered. However, rest of money is not being collected from last 1 year or 2 years. Then specifically reasons should be inquired upon. If there are multiple units like this in a particular project, then the auditor should inquire about the reasons for such things. Bookings made subsequent to the balance sheet date, we have discussed that it should also be seen. Title of land, disputed, undisputed, it is again very much relevant. This will also play an important role from the aspect of funding and liability with regard to additional claims. Project advances, realizability, nature. So many times it happens that in case of real estate projects, project advances are being given. So whether they are in the nature of project advances or loans and advances, that should be seen. Loans and advances, we have seen that the another factors with regard to index, the notional component will come into picture with regard to recognition of interest and all. Whereas in case of project advances, it will not get triggered. So that careful evaluation and analysis will be required, and documentation is also required to be seen. Lease rental income, if the lease model is there and lease rental income is recognized, then straight lining method should be followed. Then amount collected from customers we have discussed, that should not be shown as part of trade payable, should be shown as part of other payables. Tax on unsold inventory, this is one of the important factor while creating provision for tax. So if the income tax act says that if the units are not sold for more than 2 years after the OC is received in the financial year, then on deemed basis, the taxation is required to be levied. So this is also one of the important thing while creating provision for taxation. In case of investment property valuation, disclosure should be given how it has been valued, and breakup should be given with regard to land and bank. Booking of interest on cancelled flat, if it is required to be paid, it should be factored. As per the RERA Act, it is required to be, so it has also to be seen. Token money, it has been observed that token money is received, GST is not booked and not paid, and then token money is cancelled. And it is when it is cancelled, it is not paid back, it is recognized as income. So GST element is there. It's a very small amount. So many times we have seen 1 lakh rupee, 2 lakh rupee token money. So it has to be seen from that perspective. Sales below ready reckoner rate we have discussed. High variation we have discussed. Litigations we have discussed. Uneven investment in partnership form. So there may be a possibility that the ratios are different and the investments are large. So again, it has to be looked upon from the perspective of prejudicial to the interest of the company. Amount collected on behalf of that others should not be recognized as a part of revenue. Another important thing one has to see and one has to evaluate. So as we know that in case of partnership form, the audit is not mandatory. Whereas in case of companies or LLP, the audit is mandatory as per Companies Act. In case of partnership form, however, it may be a possibility that there is a revenue beyond the threshold prescribed by the income tax department for the purpose of tax audit. So when the tax audit is being done, what kind of form should be issued? Form 3C or 3CB. So one has to be important as an auditor that, so it has been seen that in many of the cases, people are issuing Form 3CB saying that this is a tax audit which is being done as per the requirement of Income Tax Act and not the audit is not being done as per the any statute. But one has to be vigilant here that RERA Act requires all real estate entities to get their accounts audited within a time frame of 6 months. So even though if there is a partnership firm which is having a real estate project, the audit is mandated as per the RERA Act and as per the provision of Income Tax Act. In those cases, Form 3CA will be required to be issued and not 3CB. So this is something which is important. Then Rule 11, we have seen that from last year onwards, a new rule has come into the main audit report for the purpose of reporting about grouping of fund. So that is also one of the important things the auditors will have to see and will have to look into this, whether that particular clause is being triggered or not when the funds are being given by the parent to the group entities and from where it has got grouped. And adequate disclosures are also required to be given in Schedule 3. Then about reporting in CARO. So there is a reporting requirement about quarterly return statements filed by the company with banks or financial institutions on the where the funds are borrowed on the basis of security of current assets. So it's being normally presumed that there are no current assets. The loan is being borrowed by the real estate developer on inventory. However, one should be aware that inventory is actually a current asset. Though it's immovable in nature, it's a current asset. It's not a non-current asset. And accordingly, this clause will require reporting. It will not be called as a not applicable if the threshold is of more than 5 crore with regard to borrowings from the banks or financial institutions. CAM is one of the important thing, again, as we know, key audit matter in case of listed companies. So it can be carrying value of inventory or impairment of loans or investments. SA 250 is a auditing standard which deals with consideration of laws and regulations in an audit of financial statement. So as we have seen that there are various laws, various regulations which are applicable to real estate. So we have to look into this auditing standard thoroughly when we do the audit of real estate project. And we will also have to look into the requirement of RERA regulations. And if it is material in nature, I mean, the criteria will be triggered for reporting. NOCLAR will be relevant for listed companies. As we know, NOCLAR is called as non-compliance of laws and regulations. And it is applicable for listed companies having net worth of more than 250 crore. Again, this will be in line with SA 250. So the auditor will have to be cautious. Here, all all chartered accountants who are employees of the listed real estate companies who are holding key positions, for them also NOCLAR will be relevant. So one has to be vigilant about the material non-compliances in the respective listed entity. NAFRA circular, recently NAFRA came out with a circular, again that should be seen and should be looked upon. If there is any fraud on the company by officer or employee of the company which is of more than 1 crore, irrespective whether it is found by the auditor or by anyone else, reporting will be required to the central government. So friends, with this we have discussed with all the various tangents and aspects of the real estate, and we have also touched upon the reporting requirement in the audit report or with the various regulators. So thank you very much for your patience listening. With this, I believe whatever I was able to share with my limited experience, I have shared that. And happy to take any questions if anyone has.
Thank you so much, sir. Thank you so much, sir. Before I proceed with the question and answer session with the chairman, sir, of HR branch, I invite the honorable chairman of Committee on Insolvency and Bankruptcy Code, as well as the vice chairman of CP Committee of ICI, CA Shri Gyanchand Mishra ji. He has already joined. So on behalf of AASB of ICI, I extend my warm welcome to you, sir, on this 102nd CP program organized by AASB of ICI. Before we proceed for the question answer session, I request Honorable Chairman Committee on Insolvency and Bankruptcy Code, CA Shri Gyanchand Mishra ji, for his keynote address. Over to you, sir, please.
So thank you, Anil Lal ji, very respected Secretary of the Committee, very distinguished Speaker Amit ji, and of course, Chairman of HR Branch Paramjit Singh ji. In absentia to the Chairman of AASB, my good friend CA Sanjeev Singhal ji, Honorable Council Member and Vice Chairman Vishal Bhai, and respected participants, good evening to all of you. Friends, at the outset, let me congratulate the board. The way they are working is really a matter of great privilege for all of us. The real, soul of the board that is being met out under the leadership of Sanjeev Bhai, and the type of programs the board is coming with, the type of activities they have undertaken during last 1.5 years, we have witnessed that this is really tremendous and indeed for the best benefit of the professionals at large. Today's program, I was just listening, Amit Bhai, was a really wonderful deliberation. Real estate sector is basically a sector which is as of now flourishing in the country, and as well regulations are also there. So while talking about the audit considerations, both the financial disclosures as well as with respect to the regulatory issues, both needs to be taken care of very seriously by the auditor. Friends, as far as condition is concerned, cost allocation is concerned, all these things are also governed by local, state RERA laws. So I think that these things have been duly discussed by Amit ji, and this is one area where each and every chartered accountant is practicing, whether in the shape of auditor or a lot of times we ensure that sort of purchase or sale of the property, though the auditor might not be dealing, a lot of consultancy work is also in the market, where we need to pay this amount or that amount. So I'm thankful to Sanjeev Bhai for giving this opportunity, and I'm sure that by the deliberation of Amit ji, under moderation of Paramjit ji, everyone must have enjoyed this. But questions very much with respect to the thing I'm reading. The first, how to book the sale, and the second, how to allocate the cost. That is very much needed, and how the supporting be taken into consideration for the same. So friends, without taking much time, as the session of learned speaker is been concluded, the question answer to be taken. I congratulate and compliment again to the board under leadership of Sanjeev Bhai, and I compliment to each one of the participants for your valued time, and I am sure that this learning session will keep on growing and going always. Thank you, Anilji, for
Thank you so
giving
much,
us the opportunity to interact with the members.
Thank you so much, sir. Thank you so much. It was a gracious, sir, for your words of wisdom. Thank you so much on behalf of AASP of ICI, who have enlightened us with your words of wisdom, sir. If you kindly permit, can we start the question answer session, sir?
Yeah, please continue.
Yes. Thank you so much, sir. Thank you so much, sir. We have with us Chairman of the SR branch. Sir, over to you, sir, for the next session of the question answer session, sir. Over to you, Paramjit Singh, sir, please.
थैंक यू सर सी ज्ञान चंद्रा मिश्रा जी, थैंक्स सर, आपने भी अपने 2 वर्ड्स दिए। रियल सेक्टर रियलिटी के अंदर आज के टाइम में बहुत नीड है, और हमारे बीच में कुछ क्वेश्चन आए हैं, तो सी अमित जी से मैं कुछ क्वेश्चन पूछना चाहता हूं जो हमारे मेंबर के आए हैं। सर, फर्स्ट क्वेश्चन है, इन केस ऑफ रीडेवलपमेंट अंडर 33 सबसेक्शन 7 ऑफ DCPR 2034 Mumbai, a tenant of commercial premises is given new constructed commercial premises of bigger area on ownership basis by the landlord. Builder want would be the GST implication on the tenant, and if applicable, at what point of the time and how the value be computed?
So Paramjit ji, so what I understand that their question is more with regard to GST and not with regard to audit or accounting. So GST, I mean, as we know, in case of redevelopment, I mean, there are some set of different thoughts and certain aspects which are still litigative in nature. So can't describe in much clarity that what will be the implication, but one will have to take help of the experts with regard to GST on the matter which they have described with regard to redevelopment.
Okay. Sir, हमारा next question है, whether RERA applies to completed project before RERA came into effect, but possession is not given to allotee and common area is not handed over to the association.
So Paramjit ji, in this case, what is the question? So the fact is described that the allotment is not being done, if I understand it correctly. So what is the question? Can you please repeat?
Whether RERA apply to complete project?
No. So Paramjit ji, sorry, you are on mute.
Common area is not handed over to the association.
So RERA does not apply to the completed project. So RERA applies only to the projects which are in process. So even before, so RERA came into existence in 2017. So prior to that, if a project is completed, it is not applicable on that. But after that, it is there. Then the developers were required to register their projects and they were required to get complied with that. So RERA will be applicable if it is with regard to the development after 2017.
Thank you, sir. What do you mean by facilitation payments?
Facilitation payments. So many times it happens that, I mean, as we see that it's been given to certain parties where we need to carry out certain set of transactions. So as we know that in real estate, sometimes it happens to have some kind of clearances. So not necessary, I mean, may not be required as per the regulations, but it's being done. So this is something which one has to identify and one has to see that those kind of practices are not there and those kind of costs are not being recognized by the respective developer in the books of accounts.
Thank you, sir. Are the detail in financial to match with RERA filing?
Sorry, what?
RERA filing के साथ financial detail को कैसे match किया जाए?
So RERA's along with the RERA filing, the financial should be mapped. So as I had explained in the earlier slides, there should be a reconciliation which will be made between the books of accounts and RERA. So there will be some differences between both of them. So as we see that in case of bank statement, there may be a possibility that the bank balance in bank statement is different, and in the books of accounts it is different. But then we prepare a RECO and we understand the reasons. What are the reasons? And whether those reconciliation reasons are required to be impacted in the books of accounts or not. So on similar lines, we need to prepare a reconciliation between the RERA records and the books of accounts. And based on those reasons identified in the reconciliation, one has to see whether it requires any implication in the books of accounts or not. So the reconciliation will have to be factored by keeping both the sets of records simultaneously.
Thanks, sir. And next question, sir. What to keep in mind while valuing semi-finished building?
Semi-finished building means
Valuation.
sorry.
Valuation, sir, semi-finished building.
Valuation, so it depends upon, I mean, if it's an unfinished building and if it's going on right now, it will be a normal valuation. But if it is a kind of semi-finished building which is lying as it is from a long period of time, so it may be called as a distress sale kind of thing, or maybe like if it is lying in the books of a company which is not able to fund this particular project and the position of the company is not in a good health, so it will be a kind of distress sale. So the valuation in case of distress sale will be different. In case of normal sale, it will be different. So it depends what kind of facts and circumstances are available, and based on that, valuation will be evaluated.
Thanks, sir. And next question, sir. One old flat which was possessed by me since 1997 and redeveloped is fixed. He is offering roughly same area, but floor on lucky draw system. Now he is offering rent of 15,000 per month for 2 years. Now land to know whether it is transfer of properties and capital gain is attracted and rent receipt is to be added in my income.
For this, I mean, I'll request that, I mean, it will require more detailed evaluation. So the facts and circumstances and the details should be discussed with the respective tax professional who can guide into this. Because with this incomplete fact, there may not be the appropriate conclusion. So one will have to have all those relevant facts in place and then conclusion can be made.
Thanks, sir. If the project is RREP holding commercial area for lease, is same allowed to be shown under PPE?
Sorry, what is RREP?
RREP likha, sir. If the project is RREP holding commercial area for lease, is same allowed to be shown under PPE?
So if I understand the question correctly, it's like a project which is holding the, if it's a developer which is holding the project for Paramjiji hold. So segregation has to be done accordingly in the financial statement, and the relevant disclosures will have to be given in the notes to accounts.
Last question is, sir. As per RERA, a real estate builder cannot accept consideration from customer more than 10% of unit cost without first entering into sales agreement. However, builder is accepting more than 10% without AFS, so it is a statutory non-compliance. As builder undertaking that customer is ready to pay without builder demand.
No, so I mean, it's a clear-cut breach of the requirements of RERA Regulation Act. So that has to be complied with, and either, I mean, the customer can deny to pay the amount to the developer or can insist to get it registered. Even if it has been insisted, either the customer can withdraw or can seek the intervention of RERA authorities.
Thanks, sir. आज के हमारे क्वेश्चन थे सर. आपका सेशन बहुत ही बढ़िया था सर, नॉलेजेबल था सर. आशा करता हूँ सभी मेंबर को पसंद आया होगा सर. और अनिल जी कुछ कहना चाहेंगे सर आप?
Thank you so much, sir. Thank you so much on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India. I extend my warm thanks to the today's speaker, Amit Hundia ji. Sir, it was a wonderful and very, very knowledgeable deliberation. You have covered all the aspects of auditing relating to real estate sector. So once again, on behalf of AASP, I extend my warm thanks to you, sir. And also, I am thankful to the Honorable Chairman of Hisar Branch, CA Paramjit Singh ji, for your valuable time and enlighten all of us, as well as throughout the 2-hour session, and as well as joining this AASB webinar. Thank you so much, sir. Thank you so much,
Thank you,
Amit,
sir.
sir.
Thank you.
Thank you so
Thank you.
much.
Thank you. Thank you. Thank you, Paramjit.
Thank